Good evening. Good afternoon. Sorry. Hope you are good. It's Emma here again. And today, I want us to solve 2023 past lesson for business finance 2 so that we can get ready or prepared for the upcoming exams, right? Yeah. So today, I think this is about 75 questions. Yeah, 75 questions. So I'm going to try my possible best and then do it within the shortest possible time, right? Yes, I wanted to do it bit by bit, but I don't want to really. Maybe I might not be. Uh, maybe when I'm doing half, I will not be able to continue. So let me do it at once. Yeah. So quickly, kindly subscribe and then like this video. Subscribe to this channel and then like this video. Yeah, if you find it helpful. All right. So now let's start with question 1. A company paid a dividend of 1.6 cedis per share a year ago, and dividends are expected to grow at 6% annual rate indefinitely. If the stock sells for 37 cedis per share, what is your best estimate for the cost of equity? So for the cost of equity in absence of beta, right, we use the dividend growth model to solve for that. And remember, so for question 1, remember dividend growth model is to get a price of a share, right? If it's the dividend in year 1, then R minus G is equal to the price of a share, right? So here we are looking for the cost of equity. The cost of equity is the same as the rate, right? So the rate is the same as the cost of equity. So now we are going to make the rate the subject in this equation. So without wasting time, when you do your change of subject and then make R the subject, the formula is going to be R is equal to D1 over P naught plus G. That's going to be a formula, right? And in the question, we are giving dividend a year ago. So since we have to solve it D1, we have to go it by the growth rate is expected to grow at 6%. So you have to go it by the 6% and then now solve for this. So let's do that quickly. So this is going to give us D1 is equal to D0 times 1 plus 2, right? So 1 plus 2. So D1 is going to give us 1.6 times 1.0. Yes. So we are going to get 1.696, right? So 1.696. Let me do this first. So now since R is going to be, so now with R is going to be 1.696 all over. The price was 37. And then the G is 0.06, which is the 6%. Right. So we are going to get 0.1058, which is also equal to 10.58%, right? So the first is 10.58%, which is E. Question 1 is E. So now question 2. Question 2. Alpha Industries can issue perpetual preference stock at a price of 47.5 a share. The issue is expected to pay a constant annual dividend of 3.8 a share. What is the company's cost of preferred stock, right? So it's the same thing as what we did, but here is preferred stock. Remember, for the price of a preferred stock, if you want to find it, the price of a preferred stock today is equal to D1 over R, right? So if we trace this formula by looking for R, it is going to be R is equal to DI over D1 over P, right? P naught, right? And then in the question, we're given D1 because here for the preference share it doesn't grow, the dividend doesn't grow, so here it is constant, so we are going to use the dividend as D1. So 3.8 divided by, so we are looking for R, divided by 47.5, and it is going to give us 8%. Right. So giving us answer option C. So now, question 3. Question 3. The Ensna company currently outstanding 10% coupon bond have a yield to maturity of 12%. The CF believes it could issue new bonds which provide similar yield to maturity. If its marginal tax is 35%, what is the company's after-tax debt, cost of debt? So we are now looking for cost of debt after the tax. So what you are going to do is you are going to multiply the rate of the debt, right, by its tax savings, then we will get the cost of debt. So the rate or the yield to maturity is the same as the rate, right? So the yield to maturity is 12%. So how we are going to do this is 12% times into bracket. Okay, let me convert it to percent. 0.12 times to bracket 1 minus the 0.35, which is the tax, right? So this is going to give us 7.8%. So cost of debt equal to 7.8%, which is answer option C. So question 4. The Antelope Corporation common stock has a beta of 1.15. If the risk-free rate is 4.5% and the expected return on the market is 11%, what is the cost of equity? Remember, when we were dealing with risk and return, we came up with a formula which was the risk-free plus the beta into brackets the market premium or the market risk minus the risk-free. So this is the same as this is also the same as the market premium. This one is also the same as the market premium. Right. So now they give us the risk-free to be 4.5%, right? Which is also equivalent to 0.045. And then beta was 1.15. And then RM was 11%, 0.11. And then the risk-free is 0.05. 0.5, sorry. So now, when we do all this, what we are going to get is going to be 11.98%, which is answer option B. All right, so question 5. The company is 40% financed by risk-free debt. The interest rate on the risk-free debt is 10%, and the expected market risk premium is 8%. And the beta of the company's common stock is 0.5%. What is the after-tax weighted average? What is the after-tax weighted average cost of capital, assuming that the company pays a tax of 35%? So this, we've already treated this kind of stuff in the sessions already. So if you don't really understand weighted average cost of capital and the like, kindly watch. I have a video on it on this channel, and kindly watch it and then get the idea. Right? So question 5, weighted average cost of capital, WACC, is equal to the proportion of equity, right? So equity all over the firm value. The firm value times the cost of equity. Cost of equity plus the proportion of debt all over the firm's value times the cost of debt. But cost of debt will have a tax savings, so 1 minus the times the 1 minus the tax savings, minus the tax, right? So now in this question, our equity component was 40%, right? But we don't know the cost of equity, so we have to first solve for the cost of the equity first. So cost of equity, which is the same as the R, since we have beta in it, right? So we are going to use our risk-free rate plus 0.5 beta. Then the market risk premium is 0.08. Then we are going to get our cost of equity to be 14%. So after getting the 14%, what we are going to do now is we've now gotten the cost of equity. So now let's solve for the WACC now. So WACC will be the proportion of this thing. So it was 40%, so 0.4 times. That is this is for wait, let me start from. The cost of equity is the proportion of equity is 0.6. So 0.6, let me see. Okay, the company is 40% financed by debt. So meaning that if 40% is debt, then 60% is equity, right? So 60% times the cost of equity 0.14 plus the debt component 0.4 times the risk, the interest of it is 0.1, and then the tax savings is 1 minus 0.35, since it's 35%. Right. So doing all this, we are going to get 11%. So which is giving us answer option C for question 5. Question 6. Apex Wafer Company paid a dividend of 1 cedi per share a year ago and has a price of 20 cedis. If this dividend is expected to grow at 12% rate forever, what is the firm's required rate on equity using the dividend approach, right? So here today, also asking us for the cost of equity, like what we have been doing. So remember, our required rate is equal to D1 over price plus price. So now in this question, we have to solve for D1. Let me move as fast as I can. So D1 is equal to D0, we growing D0, right? So D0 was 1, and then it is going at 1 and 12%, so 1 times 1.1 is going to give us 1.1. So now our R is going to be 1.12 all over the price, which is 20 plus 2. It is going to be 17.6%. Sorry, a bit headache. So answer option C is the answer. Question 7. A bank recently issued a preference shares that will pay dividend per share of 5 indefinitely. If its current price is 20, what is the required return on this stock? Kindly pause this video and do this yourself. Pause this video and do this yourself. Pause this. We've solved similar question like this already. Right. So the R for a preference share is going to be, as we know the formula already, is going to be D1 over P0, which is equal to 5 over 20, which is equal to 0.25%. 0.25, it is equal to 25%. So answer option D. So question 8. Question 8. Man's company was recently formed to manufacture a new product. It has the following capital structure. So it has a debentures of 6 million, a preferred stock of 2 million, and then a common stock of 8 million, right? So they all constitute what, 16 million, right? So giving a marginal tax rate of 50%, cost of debt of 13%, and cost of common equity is 18%, cost of preferred stock is 12%. Right? What is the firm's WACC after tax? What is the firm's after tax weighted average cost of capital? So we know the formula for WACC already. WACC. You know it already, right? But here we are just so the equity all over the firm value times the cost of equity plus debt all over the firm value times the cost of debt times 1 minus the tax rate. And then here we have preference share. So preference share also comes as preference share all over the firm value times the cost of preference share. Right. So that's what we are going to do now. So this is going to give us so equity is 8%. So 8 over 60. I'm clearing all the zeros. So 8 million over 60 million. And the cost of equity here is the cost of equity 18%, so 0.18 plus the cost of debt now is going to be 6 all over 16 times its cost is 13%, so 0.13, and then the tax savings is going to be 1 minus 0.4 plus 2 for the preference share 2 over 16, and the cost of preference share is 12%, so 0.1. So in doing all this, we are going to get 0.13425, which is equivalent to 13.43% when we round it to the discount. So 13.43%. All right, so it's the same as 13.4%. So as option A. So we just finished 8. Wow, time is reading. 9. 9 is going to be, so they say we should use this information to answer question 9 and 10. Pattern Paints Corporation has a target capital structure of 40% and 60%, 40% of debt and 60% of common equity. The company's before tax cost of debt is 12%, and its marginal tax rate is 40%. The current stock price is 22.5%, 22.50 cedis. The current dividend is 2 cedis, and the dividend is expected to grow at a constant rate of 7%. What is the firm's cost of equity? So now, so as you already know, cost of equity means you are looking for the R for the equity, right? And it is going to be D1 over D0 plus G. And then we only know for D0, so for D0, so D1 is going to be 2 times 1 plus the growth rate, which is the 7%, so 1.07, which is going to give us 2.14. So 2.14. Now we've gotten the D, so now it is going to give us 2.14 over the price, 2.5 plus growth, and we are going to get 16.51%, right, as the cost of equity. So that is answer option C. Right. So question 10, sorry. 10 is asking us, what is Patton's paying after tax weighted average cost of capital? Right. So its WACC is now going to be using the formula that we already know. I don't have to repeat it again. So the proposition of equity times its cost, which is times the 16%, 0.1651%, plus the proposition of debt, which is 0.4 times 0.12 into bracket 1 minus 0.4. Right, it is for the debt we apply the tax saving. So in all, we are going to get 12.79%. So 12.79% is answer option D. Question 11. What is the required rate of return on a company's stock if its beta is 0.8 and the risk-free and market risk premium are 8% and 10% respectively? So remember this thing in the cost of equity is the same as the R, right? So remember, since we have beta, right, we are going to use cost of equity, or R, is equal to the risk-free, the same thing, plus the beta into bracket the market risk premium, which is the RM minus RF, right? And then we have the risk-free to be 8%, 0.08, plus the beta is given to us as 80%, or 0.8 to 0.8, and then the market risk premium has been given to us already, which is 10%, 0.1. So in all, we are going to get 16%, which is answer option B. So question 12. Yin and Yang Company Limited purchased a share of KOBC.net common stock exactly 1 year ago. During the past year, the common stock paid an annual dividend of 2.4. The firm sold the stock today for 85. What is the rate of return that has been earned, right? So the rate of return that has been earned is, since we have the presence of dividend, so the rate of return is going to be the capital yield plus the dividend yield. So rate of return, total rate of return, or total rate of return. So R is going to be capital yield plus dividend yield. Right. So when we are doing all together, it is going to be capital yield is basically T1 minus T0 over T0, while dividend yield is basically the dividend over the T0. So dividend over price, right? So in total, let me do all straight away so that this particular question, I don't want to be wasting time. So we are going to get 55 minus 45 all over 45, but plus the dividend. That's the bottom. So this is going to give us 94.2%, right? Which is answer option C. Ask question 12. So question 13. The dash is defined as the present value of all cash proceeds to the investor in a stock. So the dash is defined as the present value of all cash proceeds to the investor in a stock, which is the intrinsic value. Right. So the answer is C. 14. You wish to earn a return of 13% on each of two stocks, B and C. Stock B is expected to pay a dividend of 3 cedis in the coming year, while stock C is expected to pay a dividend of 4 in the coming year. The expected growth rate of dividend for both stocks is 7%. The intrinsic value of stock B is, so now if you really want to get this answer correctly, you have to solve for the intrinsic value or the price of the stock for both of them, and then you now come to the options and then answer this. So let's do this quickly. So for stock A, this C, okay, it was B and C, so stock B, sorry. For stock B, we are going to get, remember that this is dividend over R minus G, right? So 3 over 0.13 minus 0.07, and we are going to get 50, and then stock C is equal to, when we want to solve for the price, we are going to get 4 over 0.13 minus 0.0, and then we are going to get 66.7. 66.7. Right. So looking at here, we can see that the value of C is higher than the value of B, right? So now, or the value of B is lesser than the value of C, right? So let's look at it here. So the value of stock B will be, and we check here, it's greater than, no, it is not greater. When we check here, it is the same as, no, it is not the same. When we check here, it is less than the intrinsic value of C. So the answer option C is correct. So we are now, 14 is the answer option C. So 14 is the answer option C. So let's go to 15. according to the dividend constant growth model, right? The higher the discount rate, the higher the stock price. The growth rate should be larger than the discount rate. The value of the stock is a function of its expected growth rate in dividend. The value of the stock depends on the holdings of an investor. So for question 15, the answer is C. Question 16. Redman's stock price is 35 and the dividend per year is 2. The appropriate discount rate is 13%. What is the expected price of Redman 1 year from now, right? So now, Redman's stock price is now 35, and it also pays a dividend of 2. So the discount is, so if we are going to find for this, then we don't know the price in year 1. So now what we are going to do is, remember the R that we used, right? Remember we recently used something like this. R was equal to P1 plus P naught all over P naught plus D, right? So we are going to use the same thing, but here R is given. We have R to be 13%, so 0.13, right? And then we don't know the price in the next year, so let's represent like P1. And then the price of today is, it is supposed to be, let's see whether that's already. Okay. Yes. So this is the same thing. This formula is given as this E1 minus E naught plus E all over E naught. So that is it. So we don't know for P naught. We don't know for P1. So here is going to be 35, and then the dividend that was given is 2. All over P naught is 35, right? So now our this is going to be this multiplying this, and then we make this standalone. So 35 multiplying 0.13, we are going to get 4.55 is equal to P1 minus 35 plus 2. So, okay, let me simplify this. So, minus, so, no, but it will leave it minus 33, right? So, now, let's be standalone and this coming, so 4.55 plus 33 is equal to P1. So now P1 is going to give us 57.55. So the answer option is C. 16 is C. At the end, a firm has a return on equity of 20% and the dividend payout of 40%. Its sustainable growth rate is, so Remember, sustainable growth rate is equal to the return on equity, or the R, times the retention ratio, right? So we have to now look for the retention ratio. So it is going to be R times retention ratio. So now we have dividend already. So minus 1 minus the dividend is going to give us our retention ratio. So R here is already 0.2 times 1 minus 0.4, right? When we do this, we are going to get 12%. So B, 17 is B. $18. At the end of the year, Madelo Consult will pay 2 cedis dividend per share, an increase from the current dividend of 0.5 per share. After that, the dividend is expected to grow at a constant rate of 5% if you require 12% return on the stock. What is the value of the stock? So this is a supernormal growth stock. So what we are going to do is we are going to find the price at where it became constant, and then discount it back with the dividend that has been paid, right? So the price when it became constant is equal to 8, so 2 times the growth rate. Is the growth rate. The growth when it becomes constant, 1.05. I'm just doing it fast because all over R minus G. R is 13%, right? R is 12%. 0.05. And we are going to get 30. Right, we are going to get 30. So now let's discount them back. So the stock value is going to be 2 that has been paid over 1.12 plus. So you can also, if you like, you can do it 30 plus 2 over the same distance, and we are going to get a price of 28.57. So 28.57 is B. So the answer option is B. So question 19. So we are now coming to filling the blank. If you expect to enjoy a return, so we are solving this from 19. If you expect to enjoy a return of 20% on a stock, that's recorded capital gain yield of 13.5% and has an initial price of 35. What dividend would you expect to be paid, right? So now it is almost similar to what we did the first time, but this time around it is D we are coming to solve for, right? So we are going to use the same formula. R is equal to P1 minus P naught all over P naught plus D, right? So now what we are going to do now is we are going to break this down because we have capital yield. Capital yield is P1 minus P naught all over P naught, right? And dividend yield is P all over P naught. So we've broken this into two. Our R is here, right? We've broken this into two. So in the question, we were given our rate to be 0.2 and then our capital yield to be 0.135, which is 13.5% plus D over the price today was 35, right? So let's bring this here. So 0.2 minus 0.135 is equal to D over 35, right? So we are going to get 0.065 is equal to D over 35. So this multiplying this, we are going to get D is equal to 2.275. Right. So now everything. Now the answer option is okay. Here we are filling. So this is answer 2 points. So bring the city sign. Oh, it was in Ghana City. What dividend paid? Okay, so it was in Ghana City. So it is going to kindly bring the sign. 2.275 Ghana City, right? Or when you run it, it's going to be 2.28, right? All right. So now this is for question 9. So let's go to 20. Wow, my time is almost gone. It's already gone. Okay, so question 20. Just today, Fauzia Food Incorporation common stock paid a 1.4 annual dividend per share and had a closing price of 21. Assuming that the market required rate of return is 12% and that the dividend are expected to go at a constant rate forever, calculate the growth rate. So remember, they are saying that it just paid 1 point this thing. So this is going to be D1, where the dividend per share and had a closing price of 21. Had, I mean that the old price was 21, and this is the dividend today. Don't confuse. If it had said that it has a price, then it means that this is going to be P1. As soon as they say it had a price, so it is going to be P0. So let's solve for this. Question 20. We know that the price is going to be D1 over R minus G, right? So now we are come to solve for G. You can do change of subject and get your G like the way we did for R, but in all two is the same. So now P0 here is 21, and then D1 is 1.4, and then R is 0.13, and then G we don't know G. So that's what we are going to solve for. So when we multiply this by this, we are going to get 2.52 minus 21 G, which is equal to 1.4. So now, what we are going to do now is, let's bring 1.4 inside here. 2.52 minus 1.4 1.4 and then send 21G outside. So we are going to get 1.12 is equal to 21 G. So if we want to get G, we divide by 21. And G is going to be 0.0533 or 5.33%. All right, so that's for 20. Now let's go to 21. Just today, for their incorporation, common stock paid 1.4 as usual at the closing of this one as usual. Assume that the market required rate of return is 12%, and that dividends are expected to grow at a constant rate forever, right? They're expected to go at, calculate the expected dividend yield, right? Remember the same thing again, that R is equal to capital yield plus dividend yield, right? And then we have R here already, right? We have R here already. All right, so things when I think let's calculate the dividend. Okay, so if we are to calculate the dividend yield, it's going to be that capital yield, right? So dividend yield where dividend yield is basically P over P naught, right? So the dividend here is 1.4 and then P. Here we are assuming that the same thing, so 21. Then we are going to get 0.0667 or 6.67%. So 22. Just today, for that whatsoever again, common stock paid 1.4 dividend per share and had a closing price of 21. Assume that the market required return is 12% and that dividends are expected to grow at a constant rate forever. Calculate the expected capital gain. So R is equal to capital gain yield plus dividend yield, right? Then R has been given already. They gave us R to be 12%. Then we don't know, we are looking for this. And then dividend yield is 0.0667, right? So when we bring it here, 0.12 minus 0.0667. All right, so caution. Okay. So we're going to get 5.8. 3. So capital gain yield is going to be 5.33%, right? Or 0.0, right? So 22. All right, so 22. Okay, let me finish 30 with this and then do the rest in the next video. So 20, we are done with 22, right? Okay, we just did 22. 23. Under efficient market hypothesis, a market in which stock prices reflect all public and private information is classified as. This is a strong efficient market. So strong efficient market. And then 24. Under efficient market hypothesis, a market in which stock price reflects all public information is classified as semi-strong. So strong has public and private, while semi-strong has only public. Right, so semi-strong efficient. Semi-strong efficient market. All right, so 25. Which of the following best explains the linear relationship between the cost of equity and the debt to equity ratio according to MM2? It is Modigliani and Miller proposition 2, right? So the answer here is C. Equity holders must be compensated for the high risk associated with high debt. That's why I don't know if you've watched that video. That's why you see something like this, and then yeah, and then MM2 is like this. Cost of equity will keep on increasing. This is cost of equity, and then what did I draw this one? So what is something like this? So cost of debt, WACC. Right. So you can see that even though debt has some kind of tax shield though, but if it is increasing, we can see that cost of equity to what increases. I don't know if you can watch the video. I've explained this in the video on this channel, so you can quickly do that. Let me see. Oh, why again? This say something. So the answer here is C. So 26, 25 is C. Because I don't know. I don't want to explain this again. So basically, what this means is that as we employ more debt, right, because of tax savings, our weighted average cost of capital will be decreasing, but our cost of capital, our cost of equity will be increasing because investors will be afraid that maybe debtors will take over the firm very soon. So they have to be paid high so that everything can be like to compensate or offset. Yeah. So question 26. So 25 is C. Now when is the reading, I'll just say the answer and then move on. So this is how does introducing tax in Miller and Modigliani proposition on capital structure make the cost of debt cheaper? So 26. So the answer here is the interest payments on debt provide a tax shield that enhances the firm's value, right? So number 26 is A. Number 27. A suboptimal debt and equity mix can result in all the following, except number 27 is D, financial leveraging. All the following are examples of financial distress, except financial distress costs, except ease dealing with creditors. If you are able to deal with creditors, then you are not facing financial distress. For financial distress, you are going to lose customers. You have the inability to negotiate long-term supply contracts and the opportunity cost of not making optimal decisions, right? So the answer here is T. D. According to the trade-off theory, what happens to a company's financial risk if it becomes too heavily reliant on debt? So for 29, the answer here is C. Financial risk increases as higher debt level rises, a likelihood of reducing value. So meaning that as more and more of a firm being introducing debt into its total destiny, it have a higher risk, like if financial risk increases and then it has a higher debt level because it has been introducing more debt, the likelihood of reducing its firm's value. So number 29 is C. Number 30, a company's capital structure may be different from its target structure because of the following, except number 32 is C. investment banking fees that discourage larger and less frequent security issuance. So number 32 is C. All right, I think I'm still on the page. Let me. Let's one. What should the firm consider while determining its capital structure? Considering its debt rating, what should the firm consider while determining its capital structure? Considering its debt rating. So 31, the answer is C. It should have the aim for an optimal mix of debt and equity based on its debt rating. So 31 is C. Thirty-two. In an international setting, what are country-specific factors that influence a company's choice of capital? So question 32, the answer is B, because exchange rate also influences the capital structure, institutional stability and legal system, inflation rates, and market demand also. So the answer is C. What financial ratio do analysts commonly use to evaluate a company's capital structure? So it is debt to equity ratio and then interest coverage ratio. So the answer is B. Let's repeat. How does a high interest coverage ratio influence analyst perception of a company's financial health? High interest rate coverage ratio. How does a high interest rate coverage ratio influence analyst perception of a company's financial health? So a high interest coverage ratio. Okay, so the answer is B. It suggests a higher financial risk and potential default. Because if you have higher interest rates, like a higher interest coverage ratio, then it means that you've taken more debt. That's why you're paying more interest, right? So the answer for this one is also B. B. 35. Shared financial ratios. What other factors do analysts consider when evaluating a company's capital structure? So for 35, the answer is D, which is all of the above, because if aside financial ratios, right, then if any analyst is considering to evaluate a company's capital, then the analyst will look at the industry in which the company operates, right, the regulatory environment, the extent to which the company has intangible assets. Has tangible assets, the degree of information asymmetry, which is whether information is flowing freely or not freely, or is being held by one party, and then the need for financial flexibility, right? So the answer for 35 is D. I'll be able to finish this by 4 o'clock. Then I'll be good. Okay, no, let me finish up to question 40 and then come and continue the rest in a different video. So what I just did was 35, so 36. So for question 36, how can a firm approach the determination of its optimal capital structure, right? So the answer to this question is C, by analyzing the trade-off between debt and equity financing, considering risk and cost factors, right? So the answer here is C. This is the trade-off theory. I've also spoken about it in the lectures that I've recorded so far. So the answer to this question is C. Question 36, C. Question 37. The bond that has only one payment, which occurs at maturity, define which one of these. So this is clearly a zero coupon bond because it has only one payment, and then it has no coupon payment. So it only has one payment when it matures, right? So that is zero coupon. So 37 is T. $38. The items included in an indenture that limits certain action of the issuer in order to protect bondholders' interests are referred to as okay. So that's the protective covenant. That's the protective. So number 38 is T. $39. A 1,000 cedis face value bond can be redeemed early at the issuer's discretion for 1,030 plus any accrued interest. The additional 30 is called which of the following? This is called core premium. Number 39 is core premium, which is B. $40. A bond's coupon rate is equal to the annual interest rate divided by which of the following? This is the face value. Number 40 is the face value, right? It's C. We know that the coupon rate is equal to coupon over face value. That's why the answer is C. And here is face value. Remember, I represented everything to be firm value in some time ago, but here I'm representing to be face value. Right. So this is where I end this chapter of this particular solution. So I'll record the next one very soon and also upload it. Thank you very much. Don't forget to like and subscribe if you found this insightful. All right. Thank you very much. Bye.